Greetings continue, and appreciate Les very much. And I would ask Les, as he always does and is gracious to do so, to go ahead and start us off with a prayer.
Thanks, Michael. Let's pray. Father, we're grateful for this day that you've given us. Lord, we pray for those with housing needs, those looking to purchase or sell or invest. Lord, we ask for your gifts of wisdom and patience in serving those in the community. And we continue to pray for those who work in healthcare to meet the needs of those in the community that need your assistance. Lord, we pray for those who are suffering with health issues. Comfort and protect them, Father. In your holy name we pray. Amen.
Amen. Thank you, Les. I appreciate that. On the gratitude section, I'll let everybody put gratitudes into the chat box if you have any that you want to share with everybody. Bottom right of my screen, Patrick Tesner. I already know what you're typing, Patrick, so you don't even need to say it. Patrick is grateful for his upcoming wedding, which is now within 60 days, I think. What is the countdown's of like 53 days or something? I saw on Facebook the other day. So I know he's super excited. It's just Facebook randomness pops you in the bottom left of my screen. So I had to pick on you there. Sorry about that. I am going to share an email that I was copied on, and I'll leave the author nameless right now. This was an email I got after town hall on Monday, and it just said, after Java with Johns on this past Monday. If you don't start your week with Java and Johns, it really is a great way to get yourself in the right frame of mind to start off the week correctly. They're all recorded, they're all online, but it really is something that I start my week off with. I find to be really powerful. And the email I got just said, thank you so much for today's Java with Johns on the subject. And the subject was our circle of close associates. And it really talked about the value and power of who you associate yourself with. And the email goes on to say, I can't think of any teachings that's been more useful and valuable than this one. It's really central to all of our training and was so well presented by you both. Thank you for your intensity and focus on our needs as agents. It's so easy to lose focus and get off track while often not even realizing it. I'm truly grateful for CORE, for our culture, and for you constantly reminding us of what's important and why, recentering us when we wander off the path. I can't imagine a finer work environment than my CORE family, partly because of your consistent, solid leadership and reinforcement of ninja principles and our well-defined high core values. Thank you both so much. So both, I want to thank the agent who wrote it. And I didn't get in time enough to reach out to get permission to read it, so I leave the name. I appreciate them copying me. I think those were great comments about John Brewer and John Grasillo, and I would really recommend everyone add Java with Johns to your calendar and make it a part of your week Monday mornings at 9. It really is a great way to start off. And a great refresher. They're also, like I said, they're all recorded. So if you need a refresher on something or want to catch up on some of the things that they talk about, by all means, check that out. And it really is pretty valuable. Also, gratitude-wise, on the personal side, my oldest son, Vito, turns 12 tomorrow. So Julie and I are increasingly and excessively proud of both he and Leo, but it's hard to believe that he's going to be 12 in the 6th grade, doing well, and certainly we're grateful for him. And last one that I think got buried in my, there are all these happy birthday Les things that went crazy. Was I knew I saw something from Nivja that said grateful for all the breast cancer and domestic violence survivors, which I think something that definitely deserved for me to at least read. Lots of great ones in there, but wanted to highlight that one because that's great. I passed a pink police car on Sunday, which I thought was pretty cool. There's an entire pink police car. With that, I'm actually going to take a moment, and before we talk about the market a little bit, and ask Bobette Fisher to share some thoughts with us about our pack. And Bobette, I'll let you start so I don't steal anything you were going to say, and then I've got a couple of thoughts of my own that I would just chime in with.
Thanks, Michael. I really appreciate being here today and on the town hall meeting with all my great fellow Carolina colleagues. And I refer to us as a big fraternity many times with my clients. And I had one lady say, "You mean a sorority?" Well, it's a sorority, it's a fraternity. It's just we're really blessed to have this company for sure. And I really appreciate the opportunity to talk about RPAC today. I'm really invested in RPAC. I am the chair this year for CTAR's RPAC committee. I serve on the South Carolina State RPAC as a trustee, and I've been nominated for NAR's RPAC participation committee, and that has not been released yet. So I don't know if I will get that opportunity or not. But anyway, the reason that I'm involved so much in RPAC isn't because I am a politico and I love politics. It's just because I really believe in the mission of RPAC. And I think it's really misunderstood a lot of times. So I want to start by kind of clearing up any misunderstandings that anyone on the call today might have about RPAC. First of all, as you know, the National Association of Realtors is the largest trade association, not only in the country, but we are the largest trade association by number of members in the world. So we have a lot of clout in this country. And like I said, I think RPAC is misunderstood. First of all, it is not a nonprofit, partisan, arm of NAR. RPAC does not stand for the Republican Political Action Committee or campaign. It is for the Realtor Political Action Committee. We're not red, we're not blue. We kind of talk a lot of times about that we're the purple, we're the purple group. So what our whole emphasis is supporting property rights. As you may or may not know, we've supported Joe Cunningham in the past. We've supported Tim Scott in the past, all because they supported important issues that were relative to our industry. So RPAC supports those issues facing our industry each and every day. And we could do a deeper dive on issues, and I'll touch on some issues, but I don't want to get into that. I will save that for another time. And if any time anyone has any questions about an issue you're not clear about, why it was supported, why it wasn't, if we supported a candidate, why we didn't, please let me know, or let Josh Dix know, who is our government affairs director at CTAR. But I'm here today to really appeal to you, my fellow colleagues, to invest in RPAC for yourselves and for your clients. Invest in your business. Hey, I get it. Politics is really a dirty word, and it's really, especially today, a dirty word. You want to get into a fight with somebody, start talking about politics, right? But the lucky thing for us is that we don't have to talk about the details of the issues. We've got people who will do that for us in terms of lobbyists and in terms of other volunteers such as myself, who are serving on committees. So I really want to make a point of what occurred last year. It was probably the biggest win we have had in the RPAC history. And that was that we had the right to continue to work. We had relationships here on the local level and on the state level that named us essential service. Had we not had that clout, had we not had those relationships, we would have been like some other states, and Michael, I know will speak about that, who were not allowed to work. I know that our colleagues in New York, they couldn't even call their clients. They couldn't pick up the phone. If they picked up the phone to call a client, they could have been in a lot of trouble, and could have received substantial fines for that. So anyway, I just really want you to realize that we would have been sitting around last year twiddling our thumbs for 2 or 3 months until we could kind of get some of this figured out, and then maybe gotten back to work, maybe not until the last quarter or the first quarter of this year. So please understand that was a real big win for us. The other couple of points that I really want to make is that, we have a lot of I get a lot of questions about, well, why do I have to give? And how did we get to this fair share kind of things? It's real simple. Every year, NAR establishes our goal. So our goal is based on the number of active realtors we have in the marketplace. Last year, when they established our goal, we had 6,158 members in the market. Today, we have 6,400 members in the market. So I know our goal will go up for 2022. Our goal at CTR is 170,000, $138. So far, we have received investments of almost 102,000. So we are in need of about another 132 people investing at least $30 per person to get to our goal participation goal. We have two goals, money and participation. So, and this is really interesting.
And how does somebody participate at whatever, at one of those levels, Babette? And I think you've got an event coming up this week as well.
Yeah, yep. I'm going to speak about that. I've got a link that I'll share with you to get out to everyone to participate. And if you forgot, if you have participated this year and invested this year, because when you get your membership renewal every year, Michael, you have the opportunity to just include it. The $30 is rolled in. If you don't want to participate or invest, then you have to go and uncheck that box. And this year you had to go uncheck the box twice. So we had people that just uncheck the box. They go through a lot of trouble to uncheck the box, but I think they're unchecking the box because they don't really realize the value of investing in RPAC. So
we started Don't Uncheck the Box campaign.
Don't uncheck the box. That'll come out.
Why don't you talk about the event that you guys have coming up on Thursday?
Yeah, our event coming up on Thursday is at Firefly. It's the Realtor Party on the Porch. It is an investment of, we're asking for a contribution of $35 or an investment of $35, but we're giving you something for free. We're giving you a party, we're giving you a band, we're giving you drink tickets, we're giving you food. So what better does it get? The other thing we have going on this week is the auction. It's the CTAR live auction. And there are things in there that you can bid on. And if you win something, then that money that you spend on those auction items does go toward your investment. So again, you're going to get something in return by either participating in the Realtor Party on the Porch or the auction. So that's just another great way to get you involved. But like I said, we've got a lot of issues. We can go into a deeper dive some other time. We'll share that for another time. But, we have never been able to reach our goal at CTAR. Aiken has, Beaufort has, Greenwood has, Hilton Head has, the Greater PD and Spartanburg, they are all there already. We have got just a little bit more to go, and we really need everybody's help.
Okay, why don't you put that link in the chat box and we'll send that out to everybody. I would, I'm a member and a supporter, and I would echo Babette's thoughts only because I do have friends in many states who literally were shut down completely during the pandemic. And you never know what issues are going to come up. Michael Sally was on my screen. Rob Whittle was on my screen, both former RPAC chairs. If I got the title right or wrong, I apologize. But those things really matter. When legislation comes up and they talk about including tax-free sale every 2 years up to a certain amount, or, some of the interest deductions, or something as simple as staying open during a pandemic or deemed essential. Those are the things that really matter. So I would encourage you to invest in your industry, at whatever level you're comfortable with. But like Babette said, we do have participation levels. So $30 is that participation level. And if you want, you can get a free party for that on Thursday, if that makes you feel better about it. And we'll go from there. So thank you, Babette. I appreciate it.
Thank you, Michael. I appreciate the opportunity. Y'all have a great day. All right.
Absolutely.
I'll put those links in the chat box.
Perfect. And I'm going to talk briefly about the market, just a couple of quick things, and then get really to why everybody is here. Talking about the market, September market-wide finished down about 8% in closed units. So again, down in units is never perfect, except remember, we're still talking about incredible numbers over the prior years that we saw due to the real boost post-pandemic. So we're still in a little weird spot as far as it will be the second best September ever, even though it was down 8% over 2020. Median sales price in our market was $350,000, which is up 13% over last September. So that's about where we've settled out. We've seen annual price appreciation gains right in that 13% area. Remember, earlier in the summer that was showing up as prices were up about 20 to 22%. That wasn't really a fair picture because the high end completely shut down during the pandemic. And when the high end came back, your year over year comparisons in April and May showed our prices up 22%, but that was really more a function of the high end not being there last year, and the high end's been up even more. So we're seeing median sales price up 13% year over year, which is still about 4 times the average appreciation in our market. That said, this month's Visimail article that goes out does talk about why homeownership protects you against inflation and also builds household wealth. And the last economics survey that went out estimated a 31.8% cumulative household appreciation over the next 5 years. And it talked about seeing those rates return somewhat more to normalcy. And this is a survey of over 100 economists predicting to see 2022 appreciation. Again, this is industry wide, so you're going to see highs and lows in different communities in different parts of the country. But 2022 at 5.8%, and then start to see a little bit more normalcy in 23, 24, and 25 of 3.9, 3.5, and 3.5% household appreciation. I'll send this article out to everybody. This is what will be sent out in this month's Visimail. But the point being that over the next 5 years, they're still anticipating 31.8% cumulative price appreciation. So for homeowners who think they've missed out on the market, you take a $300,000 house, that's talking about almost $100,000 appreciation over the next 5 years. So that certainly isn't the case. And obviously we still have some incredibly low rates. Dave Sansom on Sunday sent out his update from September, and that's really where my numbers are coming from. So again, make sure you're reviewing that and you're comfortable with it. He talks about the market does feel different than it did in the summer, and it does. I was coming back from Augusta on one of those 2-lane roads going 60 miles an hour, and there was somebody slow in front of me, so I turned in the left-hand lane safely and cautiously, and probably had to accelerate to, a little bit above the speed limit to pass the car next to me. Got back in the right-hand lane and slowed back down to 60. I felt like I was going a lot slower than I was before because I'd been going a little bit faster than that to pass the car. And that's kind of where we are. The summer was so frenzied that even though we have an incredibly busy market, especially for October, it does feel like things have slowed down a little bit, but there's a lot of work left to be done this year. Listings have actually trailed off a little bit, which we normally see this time of year. So we've got just under 1,800 active listings. But the important thing is to watch that gap between supply and demand. That still puts us nearly 10,000 listings below a balanced market. And that really is the metric that we're looking at, because while we're that far shy of balance, even though prices are going up at crazy numbers, and that will tamp down, you're still going to see prices go up. The reason I mentioned that 5-year cumulative price appreciation, I've heard questions from people saying, maybe this is like it was in 06, 07, 08, and maybe I just need to sell my house and wait and buy it back cheaper in a couple years. Or maybe I just need to wait a couple years till prices come down. Even though economists are predicting that price appreciation will return closer to normal levels, no one is predicting that we'll see a decline in home prices. So again, you're talking about 30% appreciation over the next 5 years. No one's talking about, we expect you can get that $400,000 house for $360, down 10% in 5 years. They're talking about that house is going to be, $560, not $360. So, make sure you understand those things. Still running about 0.9% or 0.9 months of inventory, under 30 days. Selling in 10 days is now like selling in a month. It was before. I guess the pace of everything in our world has sped up. Lots of transactions taking place on Insta-List on properties that are still coming on the market because inventory is super low, especially in certain markets. Shout out to MLS Area 62, Somerville, Ladson, and Highway 165, 0.2 months of inventory in that market. I mean, that's just crazy. North Charleston, Somerville, Ladson, 61.4 months. So those are raising, the combined for the lowest time on market, largely based on price point and availability. Mount Pleasant market's 41 and 42.5 months, so 15 days average sales time. But then you do see things a little bit. Peninsula Charleston, inside of the crosstown at 2.5 months. So it's a little more traditional, and you've seen school, and as you get, some of those things return to normal. Lastly, new construction now represents 37% of all pending contracts. And so we are seeing new construction come back on the market, a lot more new construction come back online, while we still have massive supply disruptions, and you guys know about all of those. We have seen some of the craziness, like the price of lumber, come out of the stratosphere into more normal world. But we've also seen a shift in new construction. Builders really wanting to get that house dried in, knowing what their input costs are before they price that house and put it on the market. So we've seen a little bit of shift in that, and that led really to a gap for a while in new construction inventory, where we really didn't have a lot, especially after all the new construction sales in January and February and those houses that had to be built. But now we're seeing new construction come back on the market and a build in new construction inventory. The high level of our market, historical high for permits for new construction homes, was in 2005 when we had crossed over 8,000 permits, 8,084 on a 12-month average. Right now, we're actually all the way up to 6,500. So while we're up to a recent high of 6,551 permits pulled in the last 12 months, we're still not building as many homes as we were building in 05. And if you remember from Dave's talk before, we're a bigger community, and growing. So we've got a long way to go on new home construction, but we know there's a lag there, and that takes a while. And so, that's coming online as quickly as it can, but it's not going to bail us out of our inventory shortage anytime soon. So lots going on in the market. A lot of transactions will take place in the next 2.5 months before the end of the year. December is a very, very busy month as people try to move and relocate, especially for school kids, because then they can start in January, and also some year-end situations. So just stay at it. Of course, let us know what we can do to help you. But we've obviously sincerely appreciate partnering and being in business with all of you guys. Now, I want to turn it over to really who you guys are here to see. And that is Sass Shermer. Sass is right there in the center square. Sass, how's the family? How's the baby?
Thank you, Michael, for having me this morning. Everybody's good.
How old's the baby now?
Talking about the past year flew by. My little girl turned 1 about a week and a half ago, and she's walking and running around the house, and it's a fun time in our life. So thank you all for having me this morning. Carolina One family, good morning. I hope that I have all of the answers to all of your questions this morning. And if I do not, I will most certainly get them from you. But I'm going to go ahead and try to share.
I've got a couple that I sent to Sass earlier that he's going to address. If you've got questions, put them in the chat box. If Sass doesn't cover it, I'll try to come back and hit some of those. I know some of this presentation has been done in your office, and the Carolina One Insurance is continuing to make the rounds, but they're also there on an ongoing basis for your questions, if you don't get them today. So if we don't get to them, we'll make sure Sass addresses them and hits them in one way or another. And I do have those, Sass, that I'll follow up on you if you don't get to them during the time. So go ahead.
Yeah,
I got one of my associates. We got some slides.
Yes, sir. I'm doing that right now. I also have one of my associates that is going to write down all the questions that we get on the chat box. So I'll be able to answer those in full, and I can send out a mass email to everyone as well. All righty, let's see if me and Les did this earlier. Let's see if it works for me now. All right, can everybody see that right there?
Got it.
All right, guys, here we go. I was talking to Les earlier. Been a broken record since we partnered with Carolina One in 2014, but in this ever-changing market that we have some new information regarding the NFIP and the new flood rating system. So we're going to go through all this morning. And again, if y'all do have any questions, just shoot them in the chat box, and I'll get to them at the end. And I'll also touch base on the few questions that Michael sent me this morning. So what is going on? last January, we had a big change in the platform with FEMA, and they changed the flood zones. All of that was great. It went through very, very smoothly. But now we are looking more at a complete overhaul of their actual rating system. So on how they actually get that premium. This is the first change they've had since they established the program in the 1974. And before that, it was a set rate per flood zone. You got that. In 1974, they established the first rating system, and that's when the base flood elevation and the lowest horizontal member and all of those things that we see on the elevation certificate affected the rate. So now we're changing all of that. So there's going to be a lot of changes coming, and we're going to learn as we go. So for every existing flood policy that is in the state of South Carolina or in the country, I believe in South Carolina we have over 250,000 of them. Any new business effective October 1 of 2021 is going to migrate into this new flood 2.0 rating system. So what does that mean? If you have a new construction, if you have a new purchase that the current owner does not have a flood policy, if they have a lapse in their flood insurance, for some reason they didn't pay the bill, they just didn't want it anymore, now they want it. Any situation like that is going to be placed into this new 2.0 rating system, effective 10/1. For any renewals starting April 1st of 2022, they will be migrated into this new rating system. So any new business, again, effective 10/1, started earlier this month, is going into 2.0. The renewals are getting pushed back a little bit to April 1, 2022. So if you or any of your clients start getting renewals after April 1st, y'all will see the new rating system applied to your policy or your homeowner's policy. So how is this changing? Before, we used to use the flood zone and the elevation certificate were the two biggest rate determining factors that we had. If you were in an AE or a VE or an X, whatever low risk, high risk, medium risk, whatever flood zone you were in was the main factor based on the base flood elevation and the other things we get off that EC, as I mentioned. Now, elevations are not required. Why? It's something that they decided. They don't really need them, but we are encouraging people, if they do have them, to send them to us, because it can make a difference and get a more accurate rate for us. And sometimes it can be beneficial to the homeowner, and sometimes it cannot be beneficial. It'll hurt the homeowner in the rate. We've talked to FEMA, and based on the information they've given us, if we have a set rate through the new 2.0 program and we implement the elevation certificate and the premium goes up, we get to use the lower premium. If we insert the elevation certificate and the premium goes down, again, we'll use the lesser of the two. Flood zones, I mentioned this a second ago. They are no longer the biggest factor for determining the rate. They're still required for purchase requirements. The lender may or may not require one for an X zone, or they used to not require flood insurance for an X flood zone, and they were only A, E, V, and VE required. We'll have to check with each lender specifically to see how they're going to manage that moving forward. But in the past month or so, they have kept their requirements the same as before this 2.0 system was implemented. So, big question, what are these factors? If we don't have to use the elevation certificate, if it doesn't matter what zone they're in, how are we rating these things? So here at the bottom of the screen are the 2.0 rating factors that are implemented on 10.1. Distance to flooding source or type of flooding. That is the distance to any body of water. Building type and occupancy. Is it a masonry house? Is it a frame house? Is it a primary, secondary, or investment property? Construction and foundation type. Slab, crawl space, elevated, whatever it may be. Number of floors. That's pretty self-explanatory. Prior claims. This was a rating factor that was used prior to this 2.0, but it is definitely a question that they're going to ask on the application continuing on. First floor height. If we get an elevation certificate, that will give us that information. It'll tell us the height of the lowest horizontal member of that structure. It'll also give us the crawl space information, the number of vents, the adjacent grade. All of those things can still be used to lower the rate if an elevation certificate is available. This is the big one that we noticed, total replacement cost. They are basing a lot of the rate off of the square footage of the home. This is not something they did before. We did have to input the replacement cost of the value of the home into the prior flood 1.0 rating system, but they're really putting a lot of weight on this one here. So the square footage of the home and how it's built is all becoming a big factor. Flood
Stas,
vents.
let me ask you a quick question on that.
Yes.
With prices of construction going up,
Mhm.
and the cost of a lot of things going up, how are they determining that replacement cost? And are you seeing that go up a lot, versus what maybe it used to be?
Great question. Yes. So when we start the process with your buyers and our clients, we have to do what's called a replacement cost estimator, which is a system that we go into and input the style of the home, the types of flooring, the countertops, the number of bathrooms, number of beds, the type of roof, all the specifics of that property are entered into this system, and it gives us a replacement cost value. Now, a lot of times I get the question, okay, well, that's not what we're paying for the house. We're paying 1.3 million, but you're only insuring it for 750. Well, a lot of the time, all the time, we are not insuring the dirt that the house is sitting on. We're going to give you enough insurance to rebuild that home as it sits on the property. So when we do that homeowner's replacement cost estimate, we pretty much just transfer that from the homeowner's insurance policy over to the flood application to make sure they match up correctly.
And I know this is a separate conversation than what we're having right now, but if somebody's had insurance for, say, 5 or 6 or 7 years, and we know costs have gone up, probably a little more than some of those escalators in their policy, is there a risk that me or anybody on the call or some of our clients might actually be underinsured on the replacement side? And how do you factor in for that?
Yes, there is that potential. However, there is an inflation guard that goes into each insurance policy that for every carrier, it's a little different. It could be 5%, it could be 10% that is applied every year that policy renews. So
Okay, great, thank you.
Backing up on that, we do consult with our clients at every renewal and kind of go through what they're paying now, what they have, what they've any life changes, anything of that nature. There's also an endorsement that we include on all of our policies that give an extra 25% of the dwelling value. That kind of is like a reserve tank or a retainer or kind of a cushion to eliminate that underinsured value of the home as we move forward in the renewal process. That is something that we discuss with the client on the initial basis when we're writing the policy. We talk to them about that and we say, do you want this endorsement or do you not? 9 times out of 10, they're like, absolutely. I don't really want to look at my insurance policy every year to make sure that I'm up to speed. So let's go ahead and put that endorsement on there to make sure that I have everything that I need. Does that answer your question, Michael?
Absolutely. I just know, stuff's more expensive than it used to be. And, we never want anybody to get, hit.
Yes, sir. And I'm right there with you with the price of construction and everything up. Like, I felt like it was 300% with the price of plywood and everything like that.
Sure.
It has brought that to everyone's attention. And we have been talking with our buyer clients about that on a pretty much regular basis, especially with the new buys.
And BV Missouri said
the last one on here
if there's not an elevation certificate, how do they know the first floor height?
We would not know that unless we had the elevation certificate.
Okay. So you still really need that.
Yep. That's what, like I said at the beginning, they're not required, but if you have a house that's elevated 15 feet, we just need some kind of documentation showing that it's elevated that high. The elevation certificate will give us that specific information, but there's other ways to get it if we don't have that. We can go out and measure it. They're kind of giving us the reins to kind of do whatever we want, as far as I've been told, to gather that information if there's not an elevation certificate available. The elevation certificate, y'all, also gives us, when we talk about the flood vents, we can go out there and count the flood vents on a home. We can go out there and measure them, but it's not something it's time consuming. And a lot of people have elevation certificates on file because they were required from 1974 until today, or October 1st. So moving forward, we should have those. For new construction, we should have those because the builder is going to get one to make sure that they build it up to building code and FEMA code. So they're still going to be around, but there are some cases where they're not. If we have a house that was built prior to 1974 and it was a cash purchase, or let's say the buyer built a home and bought it for cash and didn't want flood insurance and didn't waste the time getting an elevation certificate. Those are the situations that we're going to get into where we don't have it. Okay, it's not a problem. We can still get a flood policy. But if you get one, it might help us lower that premium down a little bit. It'll also give us this last little bit of information too, the machinery and equipment, location, and height. I'm sorry, let me back up to the flood vents. One of the questions on there is how many flood vents, where are they located? Are they a foot off the ground? And how many square inches are each flood vent? That is could be a potential mitigation to that property to give you that discount. Machinery and the equipment as well. Over on the beaches and even some houses in Mount Pleasant, a lot of people have their HVAC and their some other things. The hot water heater, maybe the tankless hot water heater is elevated up on the house somewhere. It might be on the outside up on its own little platform. That's also going to give you a discount on the homeowner on the flood policy moving forward. Okay, I just kind of hit on this as well, but just to mention it again, elevation, machinery, and the equipment. Again, that could be a mitigation factor. Also, the proper flood openings, those all come from that elevation certificate. Moving forward, again, we do not need that, but it could potentially help with that rate. Grandfathering and assumption of policies. Grandfathering is being completely eliminated. Grandfathering was when you had a continuous policy from the date of construction through, you can keep that rate. We're no longer, FEMA is no longer doing that. So we'll all transition to the new full risk 2.0 premium effective for the renewal of April 1st. The increases are not going to be, I'm going to talk about this, and I'm going to give you all some examples here in just a minute of what we're seeing, but it's not going to be a immediate increase in the rate. It will be an immediate decrease in the rate if that is happening, but the increase in the rate will be gradual with an 18% annual cap imposed by Congress for every year until it reaches that full risk premium that the new 2.0 is rating it at. So just for simple math, I got a $100 flood policy. Next year it's going to be $118. The next year it'll be $136. And on and on and on every year until it reaches that new full risk premium. As I mentioned, any decreases are effective October 1. So at the renewal. So if I have a policy that is getting a decrease and it doesn't renew until January 1st, I am not going to see that decrease in the premium until that renewal on January 1st. For assumptions are still going to be advisable, but at the same time, we want to make sure that we are telling the buyers and the new homeowners what their new full risk premium, the 2.0 rating system, is going to be at the beginning. So with the assumptions of policies, if Michael I'm buying Michael's house and I assume the policy for $572. I have to advise that client that they're going to have an 18% increase at that renewal. And there'll be another 18%. And then we can also tell them how long that 18% increase at the renewal is going to be until you reach the full risk premium. So let's go back to the example of me buying Michael's house. I buy Michael's house. I just want to assume his policy. It's all fine and dandy. But at the same time, my insurance man is going to tell me, okay, well, you're buying this house, but the full risk premium on this thing is $5,000 with this new 2.0 system. So your policy is going to increase every year 18% until you reach that full risk premium of $5,000. Does that make sense with everybody?
Yeah, and obviously that's going to be important for someone who's buying a house thinking their premium is going to be X a year, and it's going to be going up 18% a year for what could be a number of years. And so,
Correct.
Those disclosures are critical, and you can't just look and say, well, here's what the seller's flood was, and so here's what you're going to be taking over, because it doesn't work that way anymore.
No, it does not. And y'all, the biggest thing I can say about all of this when assuming these flood policies and for current homeowners is, as we discussed in our sales meeting this morning, if you have a current flood policy, and we do this on our end with our renewal retention and everything like that, if you or your buyers have a current flood policy and they do not want the severe increase to the full risk, new 2.0 full risk premium, they need to make sure that one, they don't cancel their policy for any reason. Let's say, oh, I don't want flood insurance anymore. I'm going to cancel my policy. Because as soon as they cancel it, they're going to go into this new full risk. So if Michael cancels his flood policy, or I cancel my flood policy, and then I say, you know what, I think I want flood insurance again in 2-3 weeks, I'm not going to be paying that $570. I'm skipping the 18% cap and going straight to the $5,000 policy. So if any policies are canceled for non-payment by a homeowner's request, anything like that, the 18% cap is minimal compared to what they're going to have to pay if they reinstate that policy. Okay. Starting a new policy down here at the bottom, it is in the best interest for the client to get the accurate rate. But if there is a flood policy established already, as long as we are advising them that, hey, Sass, you know, your policy is going to be this amount at some point. $5,000 is the max that it'll go, but it's going to increase. And they're okay with that. We'll assume that flood policy and move forward. But we are going to be letting them know about the new 2.0 rating system and the factors.
So there's one question the chat box asked about is there something agents need to disclose to clients who have previously assumed a flood policy? So let's say last year you closed and you assumed the seller's grandfathered flood policy. Basically, you know, we need to let those people know that upon renewal, their premium will potentially be going up if it is under. Now, I looked at the stats, and I think the stats were 25% of people are going to receive a decrease in a modest amount, like 50% are going to stay about the same, and, you know, potentially 20% of premiums are going to go up.
Yeah, the statistics are, I mean, they're statistics. This is going to be a property by property situation. Everyone is going to be affected differently. Before it was, hey, I'm in an AE zone and this is my neighborhood. We're all paying about the same depending on how the structure of the house is. Now it's going to be per property moving forward. So it's kind of hard to throw out a wide, like, I don't really know how to say it, but it's kind of hard to give an assumption of what everybody is going to be incurring.
Sure.
I have these statistics, right? Or some, not statistics, but I have a few examples right here in front of me that might help with answer this question. But this all sounds like it's terrible. It sounds like everybody's going to be upset. But at Carolina One Insurance, we've done our background, we've done our behind the scenes research. We've planned for something like this to happen. And we have established our relationships with multiple private market insurance companies. These are just a few of the ones that we represent, but this is looking like it is going to be the way to go for most of our homeowners. So past week, I've kind of pulled just a few different properties that we insure through Mount Pleasant, Sullivan's Island. I think I got one on Folly or Allendale. And just to give y'all an idea of what's happening, I'm going to show it to you. So for a house over on Sullivan's Island, the current homeowner is paying $513 a year for flood insurance. The policy is assumable with that 18% cap at the renewal each year until it reaches the maximum premium. With the new 2.0 system, it is $7,085. With our private market carrier, it is $929. So in this situation, we would be moving our homeowner that lives on Sullivan's Island from FEMA 2.0 system to the new private market flood carrier at $900. It's only about a $300-400 increase. That's better than $6,500 increase. That's one.
And I think that really sums up a lot of the key in that it used to be anything you do, and we've talked about this before. We've talked about this with appraisals and national banks versus Carolina One Mortgage, who's going to have a local appraisal desk. Whenever you try to layer anything across a giant area like the entire country, it doesn't really work out, and you have these extreme examples. And that's kind of what the flood insurance program tried to do. And so now, more so than ever, actually having an insurance professional who's going to look at multiple carriers and multiple solutions to see what works best for your client, whether that's their basic homeowners coverage, because obviously Carolina One Insurance is going to, represent a number of carriers, or flood, whether the government program's the best or private flood's the best. That's really what you need. No different than real estate. Is somebody really to be able to look at the holistic picture of this property and see what fits their requirements, the lender's requirements, and the homeowner's requirements at the same time. And I think
Exactly.
that does become a big difference, because you all have always had private flood options, but a lot of people don't even know what private flood insurance is, because again, usually the government was so low, they were subsidizing the program, which is why the program lost money, that this wasn't as critical before as it is now.
Exactly. I agree 100%. I agree 100% with that, Michael. Thank you. Just to give you a couple more different options. I got two more here. This house is over in Mount Pleasant. They're currently paying $810. With the new 2.0 system, it's going to $4,100. With private market flood, it's at $699. So it's actually cheaper than the flood 1.0 rate by about $200. So that's an excellent solution. Another one over on Sullivan's Island. They're currently paying $412. The new flood 2.0 system is putting it at $8,300. That is an extreme increase. With private market flood, it's at $699. So it's about $150, $200 more than what he's paying right now. And then you have this one. This one's out in Allendale. The FEMA rate with FEMA 1.0, let's call it 1.0. FEMA 1.0 rate was $7,059. So we placed this policyholder with private market initially for $4,906. So that's a $3,000 savings from FEMA 1.0 to private market. With FEMA 2.0, the premium went down another $1,000 to $3,836. So in this situation, it's benefiting the homeowner to stay with FEMA or to move from private market to FEMA 2.0. And y'all, the reason I pulled those examples is because I want y'all to see how different every single property is. It's kind of hard to give a vague explanation on what's going to happen with your buyer or with your current homeowner or seller, whoever it may be we're dealing with. So it's critical that we talk to them. We lay out all the options because we have a whole bunch of them, and we kind of customize it and lay everything on the table to say, hey, Timmy, we got this, and this. Here's what FEMA 1.0, here's 2.0, here's private market. We need to put you in private market. Or, hey, you have private market right now. We need to move you to 2.0, save you $1,000. There is a solution. We've found a solution. So there's nothing to panic or anything about. We just need to make sure that we're discussing everything with our clients and our current homeowners in more detail than we have in the past. FEMA used to be the only option. So it was go with FEMA or don't buy the house, deal with the rate increases, whatever it may be. But the beauty of our marketplace and the changes that have occurred over the past 5 to 10 years have given us the ability to shop flood insurance just as we shop homeowners insurance, to make sure that our clients are getting the best rates, the best carriers, and always have a solution for their needs.
Let me ask you a question.
Yes, sir.
I know this applies to the homeowners policy issuers that Carolina One Insurance represents, but are private flood carriers admitted in the state of South Carolina?
Just like our homeowners insurance companies, some of them are, some of them are not.
And can you talk about,
market,
there were a couple of questions in the chat box about, what if a flood carrier goes under, or goes belly up or something along those lines? Can you talk a little bit about an admitted carrier and, what the state does in some of those situations?
Absolutely. So to answer your first question, we will discuss whether the flood insurance company is admitted or not admitted. That'll be a discussion we have with the buyer as well. What that means, y'all, is an admitted carrier is backed by the state of South Carolina Guarantee Fund. What does that mean? That means if that company was to ever go belly up or was ever not able to pay their claims, that the South Carolina Guarantee Fund would be sending out money to that carrier or that client. So for example, we had a company this past year called Gulfstream. They were an A+ rated company admitted by the state of South Carolina. And I got an email on a Friday night saying that they were going bankrupt. And we had 28 days to rewrite about 150 policies to a new carrier before they shut their doors and flat canceled everyone. Well, this was an admitted carrier backed by the state South Carolina Guarantee Fund. So when we canceled those policies or we rewrote those policies, the South Carolina Guarantee Fund was able to send a refund to the client who was a previous member or a client of Gulfstream. Now, let's go to the claim side of it. Let's say I'm with Gulfstream, they go belly up, they don't have any money to pay the claim, or we have a major catastrophe hurricane. And they say, oh man, we're paying out millions and millions of dollars in Charleston, South Carolina. And SAS, I'm sorry, we don't have any money to pay you. Being an admitted carrier, the South Carolina Guarantee Fund comes in and gives me a max of $300,000 to rebuild my house to the best of my ability. So it's very important that they are admitted carriers. But again, we have some that are not admitted that have better rates. So that is something that we have been discussing more and more with our buyers, especially given the situation that we had with Gulfstream. I just logged out, so I'm seeing some of these questions.
Oh no, you can go ahead. I'll hit you with questions. You don't need to worry about too much on the chat box.
Okay. Go ahead.
There was a question about how they determine their rates, and at the end of the day, everything's going to be a risk reward. You know, people are going to have certain appetites and underwriters and figure out where things are, and that's why those private people might be better than others. You know, we all know there are areas that are in certain flood zones that we would say, but it's not really likely to flood, or it didn't flood in Hugo, or it hasn't flooded in whatever number of years. But again, when you layer things on a map, it may not be as clear. So it's always going to be.
The private market flood carriers are set up more, and their rating is based more off of a standard homeowner's policy. So each different private market flood carrier is going to have a different rating platform that they use for that area, just like the homeowners companies do. We have a group of homeowners carriers that write really, really well in Berkeley County, and if we put them in Charleston County, they're not very good, and vice versa. So it's going to be the same with the private market flood. They're customized more like a homeowner's policy than they are the FEMA standard. You get building and contents coverage at a max of $250,000 on the building and $100,000 on the contents. With private market, we can go up to $3 million on the building. So with FEMA, you weren't getting as much coverage for larger homes over on the islands or Mount Pleasant, wherever it may be. You only had $250,000. With private market, we can do $500,000, $600,000, $700,000, all the way up to $3 million. So that's another good thing. Also, it gives them more coverage to types like loss of use. If for some reason they can't live in the house due to a flood damage, insurance company is going to pay them to live somewhere else comfortably until they can get back in the home. Pool repair. A lot of people are building pools. If you get flood damage and it messes up the pool somehow, there's coverage for that on these private market flood policies as well. They do use the flood zone as a rating factor. Some require elevation certificates, some do not. So that's a property by property situation that we'll have to undertake and take control of as we get to those points. Michael, refresh me on the questions that you had from, one was about solar panels.
I did get two other questions prior to that I wanted to address. And again, these are complicated things. These are complicated issues. Again, just like the mortgage world, you really need, in my opinion, which is why we have a partner in the Shermers and Carolina One Insurance, somebody who does this full time. It's not going to be something that we're going to understand to the level of intricacy that a full-time insurance professional does. And so on your team, you need somebody that understands what's going on in the mortgage world, what's going on in the insurance world. And it's not an ad for Carolina One Insurance. I appreciate SAS trying to educate us. but really it's understand that there is a difference, and you really want somebody that's going to be able to analyze the client's needs, and take you through all of those issues. The two questions that I got before SAS, and we still got a little bit of time, we'll run a little bit over 11, but I think that's okay. The first was about condo insurance, and there were a couple of elements of that. One might be a little too big to analyze, but obviously, condo master policies and things like that are, I think, seeing some challenges in the market as you get older and older condos, and you get carriers, and rates going up, which increase regime fees, and also kind of how that interacts with maybe somebody's HO6 policy, and what the HO6 really covers, and when the HO6 kicks in relation to that kind of master policy. So I didn't know if you had any thoughts on not only master condo policies for older properties, but even homeowners policies for older properties that maybe are 40 or 50 years old. And like anything, insurance is risk mitigation. So if somebody's writing a risk mitigation policy on a brand new house with brand new wiring, or they're writing an insurance policy on a house with 50-year-old wiring, my guess is they're going to start saying we've got more risk the older the house is. So I know that's kind of a really open-ended, but I didn't know if you wanted to just kind of weigh in on that a little bit, and then I had one other after.
Yeah, I will for sure. And you hit the nail on the head there, Michael. Older homes do get a higher rate, but depending on any updates that have been applied to that home, the rate can go down significantly. Those main 4 points of older homes, and when I say older homes, guys, I'm talking about homes that are older than 30 years. As soon as we get a request for a property that's got that age on it, we ask these 4 questions. We need to know when the roof, the HVAC, electrical, and the plumbing were all last updated or replaced. Once we have that, we can get you the best rate that's out there. Like he said a second ago, a brand new house is built in 2021 with all new stuff is definitely going to get a better rate than a home built in the 40s. It's because they're built differently now. They're built more securely, strongly. There's a whole bunch of different things that have changed. With the HO6 stuff, yes, just like Gulfstream and a couple other smaller carriers that we don't represent have filled their bucket and left the area, or gone bankrupt and left the area, or filed whatever it may be, and no longer write business. On the commercial side, which is where y'all seeing those master homeowners association policies, they're doing the same thing. We had one carrier pack up overnight earlier this year and left all the HOAs doing the same thing that we had to do with Gulfstream and rewrite the policies. So that is a factor. There's a lot of loss, and like he was talking about risk mitigation, they could be in over their head. They could be giving us a bunch of information that we like to hear, but at the end of the day, they don't have the money to pay the claims. So we keep an eye on that. Going to the HO6, if you have a condo unit buyer or owner, they are responsible for ensuring everything on the inside of that unit. So as soon as you walk through the door, the flooring, the baseboards, the sheetrock, the cabinets, the personal belongings, televisions, fans, anything that you can see inside those walls is the responsibility of the homeowner. Anything on the exterior of that, so the wiring, the roof, the siding, the amenities in the area, whatever's on the outside of that unit is covered under the HOA policy. What happens when we have a fire or a water pipe break is that if I'm the unit owner, my insurance company is going to come in and say, okay, we insured the interior of this, so we're going to replace the flooring and the baseboard and some of that sheetrock over there, so we'll give you a check for 10 grand. The other adjusters, the other homeowners association adjusters going, okay, well, we got a $60,000 claim inside this wall to fix the plumbing. So there's going to be 2 claims filed, one with the unit owner's insurance company and one with the HOA's insurance company. The more HOA claims they pay out, the higher their rate and the more they're going to have an increase at each renewal. That's just how it works. Same with the homeowner. The more claims you file, the higher your rate will be over the years. A lot of times they'll subrogate too. So let's say that I live in a first floor condominium unit and Michael lives right above me. and Michael has water damage in his unit that falls through the floor and affects my unit. Now we have 3 different claims going on. I'm filing a claim with my insurance carrier, Michael's filing a claim with his insurance carrier, and the HOA is filing a claim with their insurance carrier. My insurance company, since I'm on the floor and my unit did not cause the problem, will probably subrogate with Michael's company. The HOA is then going to have a major problem because they're having to fix all the plumbing in the walls and everything underneath that flooring that comes into my unit. So again, they're filing a larger claim. Our claim, me and Michael's claim, might only be 30 grand. The HOA's might be 100. It's a case by case scenario there as well, but that kind of gives you an idea on how the insurance is impacted by the condo unit owners and the HOA. The bylaws.
And I think people picked up on when you said this, but when you talk about subrogating, it's basically shifting the loss to the responsible party. So,
correct.
If you're I know somebody who's recently in an auto accident and their insurance carrier fixed it, but then they had to pay the deductible, but then they will subrogate and try to go after the at-fault party. And it's tricky to navigate. Sass, the other question I had, and we'll see if anything comes back through. One, we had somebody ask if USAA will be affected the same way, and we talked about that. So the flood insurances, we're talking about all national flood policies, regardless of who's writing them. And then for homeowners, it just depends on individual underwriting standards as to, what's going to be impacted. But this applies to all flood policies. The other Sass was somebody asked about solar panels. So if you have solar panels on your home, are they covered under your homeowner's policy?
Yes, sir. Absolutely. It's covered under the dwelling value. I know sometimes this doesn't affect insurance as much as it does, I think, a lender, because there's leases on those and they got to transfer the lease or the rental agreement, whatever it may be. But as a homeowner, if you put solar panels on your house, we do need to know about it because it does increase the value of the home. So if I put $10,000 worth of solar, I don't know how much they cost, but let's just use 20 grand. I put $20,000 of solar panels on my house. I need to notify my insurance company so that they can increase that dwelling value to match the additions and alterations that I have implemented on my home. They are insurable. We do deal with it on a weekly basis. There's no real issue in getting those insured or put on the policy.
And I guess on that same point, and if we don't get any more questions, then we'll wrap up kind of with this. Sass, what kind of changes do you think really necessitate a call to your insurance carrier? I mean, we understand, and I'll ask, so let me jump one quick real thing, because unfortunately, Barbara, I know the answer to this. Sass, can you insure your dock?
You can insure your dock, but not through a flood policy. Some of the private market carriers are looking into it to see if they will accept it. But on the FEMA policy, your dock is not insured under a FEMA flood policy. It's insured under other structures on your homeowner's policy for fire or any kind of damage like that. But if a hurricane blows the pier head off, yeah, you got insurance for that. But most of the time when we have dock damage, it's from rising water. If y'all have seen around Charleston, it's not a brand new dock. If the dock looks like a roller coaster, that means it's had flood damage. And it's very easy for an engineer to look at it and say, okay, this is coming from flood or this is coming from wind. Some of the insurance companies that we have, we're working with them to try to see if they can come up with a product to cover flood to docks. But y'all, docks are about as expensive as a house.
So if your dock burns down, you'd be covered under your homeowners for other structures, the same as a garage. But if rising water takes out your dock, which is what most docks get taken out by, you're not covered under a flood policy.
No, sir.
Okay. So last question, and it kind of ties into the last one that's there. So we know if you buy a new car, you need to immediately call your insurance agent because you need to insure that new vehicle because it's dramatically different than the old vehicle. What kind of changes and what level of changes, Sass, really necessitate a call to your insurance carrier? Meaning, if I redo my kitchen, do I need to call my insurance broker? If I put in a pool, what kind of, if I put a new roof on my house? I mean, what level of home improvement or changes need to necessitate a call to our insurance carrier? And the last part, and it might be the same answer, was from Patrick of, who should they refer their clients to with Carolina One Insurance, or where do they call if they've got questions about impact on flood insurance, or just questions on insurance in general. I will tell you that homeowners insurance, because it's paid by most people's mortgage company and not a check that they write every year, is one of the largest unquoted items out there. You may have a policy for $2,000 or $3,000 that if you got the bill, you might say, hey, I think I need to call SAS and see if, Carolina Insurance can get me a better rate on this. But many times you don't, because it's paid from your escrows, direct from your mortgage company. And therefore, people don't pay a lot of attention to it. And I know, SAS, there are many stories where you guys have been able to save somebody money where they've been having the same policy for 5 and 10 years because they just don't shop it because, again, they're not writing that check. But SAS, what kind of changes necessitate to call the insurance company? And if agents or their clients have questions, where should they go?
Okay, I'll answer the first one first. When should you call your insurance agent? I've mentioned this in meetings before, but anytime you have a life-changing event, whether it's I had a child, I bought a new car, I got a golf cart, we bought a boat, we bought something of extreme value, it doesn't hurt to pick up the phone and call. I got married. That affects it. I have a kid that's starting to drive on Tuesday. Yeah. All those are life-changing events for homeowners. If you have to write a check for $20,000 to put a new roof on your house, that is a life-changing event, in my opinion. So anytime we start doing major work to the home, you have that life-changing event. You purchase something of extreme or high value. All those are good times to call your insurance agent just to make sure that you have the proper protection on that policy. If you're installing a pool, yes, that is something we need to know. We have to make sure that it's fenced. We have to make sure that there's no diving boards or anything like this. All of those are factors. If you get a new car, yeah, we can add that very, very quickly to the policy. Or we can at least tell you what you need to do if you are putting a new roof on, or you install a security system. That might not be a life-changing, it might be a life-changing event to protect your family, but if you don't think of it that way, those are all things that can definitely help affect the rate of your insurance policy. Moving on to the second question of that, if y'all have questions about anything insurance related, by all means, please call us at 202-843-202-2120, or you can send us a quick email to insureme@carolina1insurance.com, and one of our agents will get back with you with an answer. If we needed more information on the specific situation, we will ask, but we will make sure that you get what you are asking for to relay to your clients, or let us talk to your clients directly. Once we start talking about coverages and protection and stuff like that, you have to be a licensed insurance agent to start talking about those. We don't advise any of y'all to talk about coverage limits or anything like that to your buyers or your sellers or your current homeowners, because there's a lot that goes into it. We have to get specific licenses to discuss those types of things. So y'all, again, we partnered with Carolina One to be an asset for y'all, to help y'all and make the home buying process as simple as possible. Yes, there are some ups and downs, just like with selling real estate. We find solutions for those issues, and we can make it work and make sure that y'all have exactly what you need. I saw one question. I'm getting a bunch of them over here. I just clicked it up. What if the pool already has a diving board? We do have carriers that will allow the diving board. It is more expensive. It's a liability thing. Little Johnny goes out there and is jumping on the diving board and hits his head on the side of the pool. Someone's going to the hospital. So it could potentially turn into a lawsuit. So those pools and slides are not really, they don't qualify for everyone, but we do have people that'll take them if they're adamant that they don't want to get rid of it. Shirley said something about bad dog breeds. Okay, I'm a dog guy. My family's got a whole bunch of dogs. So I am not hurting on anyone. I hope I don't hurt anybody's feelings. But there are a list of dogs that do not qualify for certain carriers. Every dog, in my opinion, is a great dog. So these carriers have been tightening the ropes on certain breeds that we discuss with our clients. We ask them what kind of animals and pets they have. And if they have certain animals that don't qualify for a certain carrier, we move them to a different one. It's kind of like the pool and the diving board and the slide. Those are just liability issues. We're in a sue happy world, y'all. So that's why liability is taking a very, very large stance in the insurance industry. We've dealt with dog bites where the person didn't even get bit. He fell off his bicycle getting barked at riding down the sidewalk. And he fell off and broke his wrist and sued my insured for 80 grand. The company paid it out. Those things happen just when people are trying to get a quick payout. So those are why those are implemented with those specific carriers. But again, that's why being an independent insurance agency like we are, we have the ability to find a new solution. It might not be in their favor premium wise or cost wise, but there are options out there, and then we'll let them make the decision on what they want to do.
All right, I appreciate it. Again, Chip, thank you for putting in the chat box. 843-202-2120 is the direct number to reach Carolina One Insurance, or insure me at carolina1insurance.com. Sassy, you certainly provided a lot of information. As a homeowner, I probably need to figure out if I'm really properly insured, so we can have that conversation later. Because Sass has my own personal policies. And I appreciate him taking such good care of me. And I appreciate everyone being on the call. So with that, I'm sorry we ran long, but I think it was great information, and appreciate Sass being with us and sharing everything. Remember, the RPAC information is in the chat box. There's also an RPAC event on Thursday. If you are able to attend, and for your $30 minimum RPAC side, you can get some drinks and a band at Firefly. So there's a good way to do it that way if you want to support them one way or another. So at least we can make our participation goal. So thanks for everyone being here. We'll see you all in the next town hall that we'll put out shortly, but we'll have another one before Thanksgiving, and we'll go from there. So have a great week. Good to see everybody, and thanks for everything. Thanks, Sass.
Thank you, Michael. Thanks, everybody.